You can't keep spending and bring down inflation. So here's what I think. I think that we're not going to be able to bring an interest rate to a high enough level to give a good real return to holders of credit without causing a contraction in economic activity. The way it really works is you take money and credit away from people, right? And something else costs them, so they spend less. And because they spend less, then you have less inflation. Yep. All of them have been painful, and we produced a whole lot of debt. And so now even the Federal Reserve is going to start selling 1.1 trillion. And then you have the Treasury selling $1 trillion. And so there's a lot of selling. And what that does is it takes private credit. You had an 8% inflation rate. Look at what people get. And we're talking now about a 3% interest rate. And people think that that's good. Right. So you're going to lose buying power. I think the inflation will come down a bit, but it's going to be very high. And money's going to get a lot tighter. So you're going to have a stagflation, similar to the 70s, but none of them are all the same. There's always a paradigm shift. The way a paradigm shift is, it's like there's a 10-year period, and almost every 10-year period is the opposite of the 10 years before. The 70s produced the 80s. At the end of a period of time, everybody believes that the future will be like the last 10 years. Right. And everybody's positioned that way. So when you look at the environment that we had over the last 10 years, not inflation, low interest rates, availability of credit. So these moves take place typically over a period of 10 years, and there, let's say, two legs to the move. So you have a change in mindset. People thinking what is safe. Used to think that cash was safe, a safe investment. But cash it loses buying power to inflation. So now, as people realize that that loses buying power, and as the Fed has to deal with the tightening of monetary policy, you get the first leg. And that's the first leg that we're in. And when that runs its course, which it probably would run its course, I would say, in the next 18 months or so. 18 more months of, and by the way, there's nothing precise, and I'm not sure that I'm right in this, right? I'm just saying, I'm giving you what I think. That if you take the cycle, you have to raise interest rates high enough that it produces an adequate return. Otherwise, the sellers, they're going to sell their instruments. And that if we look at the supply demand for credit, the Federal Reserve is going to sell 1.1 trillion. You have the government trillion, and you have others selling because it doesn't provide a good return. That creates a certain tightness of money. That creates a fall in the contraction. You have a contraction in spending power, credit. And so that's what's likely ahead. So you have the first leg of the move. Like all classic first legs. This
is just the first leg.
These things take place until the opposite is true, until people believe that cash it won't be a good investment, until there's the inflation. So I think that you have the leg, like 1971 into 72 and then 3, tightness of money policy causes 1974-5, bad recession, bear market, easing of monetary policy. Then you get another leg up, 76, 77. Then you have the higher level of inflation. Then you have the tight money policy. And at that point, everybody believes that I never want to own a bond. I only want inflation hedge assets because that's how they're positioned. And then the opposite happens in the 80s. So it's that kind of a situation. And that's happening in a political environment. Because we're talking about markets, but we can't separate markets from politics. And we can't separate politics internally from external politics. So we also have the political situation in terms of the left and the right and the extremity of that and what that might mean in terms of policy. Matters who's in charge. Of course, there's the fight over wealth and power. And it's an irreconcilable difference politically. We have populism. Populist is a person who will fight for that one side and won't lose. They won't compromise.
Donald Trump.
Donald Trump, or it could be the opposite. Populists of the left.
Got it.
And they're populists of the right, right? And they have irreconcilable differences, and they won't lose. The question is, in the next election, will either side accept losing? And think of that as Americans asking, will both sides accept losing? Will we respect the system? And so it makes an inefficiency in the economy. Then we take other things, not just the printing of money, but we're spending without a limitation. Normally, if there was not a fiat monetary system, or you as an individual, you ask how much money do you have to spend? But now we have spending on defense, spending on rebuilding the Ukraine, spending on this program, spending on that program. There's not a limitation. These things are connected. So yes, leadership and the efficiencies matter in terms of the economy, and they matter in terms of our lifestyle, because we have these internal conflicts and external conflicts in which there's worries about self-sufficiency in case of a war. In other words, we think about trade. All of those enter into the picture. So you have a dynamic that is very similar, really, to the 1930s dynamic. I think both sides recognize how terrible a military conflict would be. But you could take something like Nancy Pelosi's trip. The fact that we're simply talking about it, that we're so close to the edge. It's not the old days. The United States used to be a dominant military power. Think about it. The New World Order began in 1945. The United States won the war. We had 80% of the world's money. Gold was money then. We were half the world's GDP, and we're a military power. So nobody wanted to fight. If you look at the history of these things over a period of time, when you have then comparable powers and there's disagreements, it can be resolved quite often by a conflict. And so that's the nature. We're no longer the dominant power. So it becomes closer. So now when we deal with existential issues for different parties, there is a risk of these things. If China became Russia, think about the economic consequences of how we're intertwined. 22% of American manufactured goods imports come from China. So just imagine China became like Russia. In other words, you say, I don't want to take imports. So people don't buy their Nikes, they don't buy their Apples, they don't buy things that are produced in China and so on. Do you know what that would mean economically for us in terms of the inflation rate and the consequences because of how they're intertwined?
Well, the argument would be it hurts China more, we say.
Who cares if it hurts China more?
Yeah.
Right? Is that a win when it hurts you terribly? Okay, so when you have a war, both sides lose. I'm just trying to be practical here. If we're looking at this, you asked the question, where are we? We are at a risky position, right? We understand this.